Hi, JJ here again with the Art of Value. Well, is Michael Burry predicting a bottom in the stock market after this current bank panic that still seems to be playing out? It seems so to me. What do you think? We'll have a look at his current tweets and see what he's said. There can be a bit cryptic, but we'll try and work out what's going on. So let's get into it. So of course, Michael Burry is tweeting under Michael J. Burry. He deletes his tweets soon after, so there's Michael Burry archive. So on screen right now, if you're on YouTube or Spotify video and Rumble as well now, Michael Burry's tweet from the 9th of March, he is talking about Enron. He says, is it possible today we found our Enron? And so, as I said, his tweets are cryptic. Back then, it was the Silicon Valley Bank run that happened. That was starting back then. He must have been looking at it. Go back and look at my last two videos about that, how it happened step by step. I'm not going to go over it here again. I am going to talk about current happenings because it's still playing out. It's kind of spreading to other banks. But go back and look at those videos if you want to catch up on that, if you don't know about that. Okay, so 3 days later, Burry says 2000, 2008, and 2023. It is always the same. People full of hubris and greed take stupid risks and fail. Money is then printed because it works so well. So again, I think he's talking about Silicon Valley Bank, people taking risks, the management of the bank. Well, it could be argued they didn't take a huge amount of risk because they bought US treasuries. It's just that they bought them at a very low rate and then the interest rates rose. But Burry would see that that was kind of irresponsible behavior and the bank had no risk management in place for the last year. So I'm pretty sure he's talking about that. And perhaps he's looking forward to the bank bailing them out in some way and printing money when the economy gets into trouble because of this bank run. Or perhaps he's talking more generally because he has been warning about the tech bubble that's happened. He was warning about Tesla, about ARK and Bitcoin, many other things, about how there was so much money printed and it caused a bubble. He may be talking more generally about that or specifically about Silicon Valley Bank. His next tweet on the 13th, he says, this crisis could resolve very quickly. I'm not seeing true danger here. So does he mean what he says here or does he mean the opposite? I've seen people on social media saying either way. Is he joking that he sees a lot of danger or he really doesn't see any danger? So it's up to you, our interpretation. What do you think about that? And so this next tweet is the most interesting, I think, where he explains the most. He says, in October 1907, Knickerbocker Trust failed due to risky bets, starting a panic. And that was known as the Panic of 1907. Two others soon failed and it spread. When a run began on a healthy trust, JP Morgan made a stand. 3 weeks later, the panic resolved and markets bottomed. A stand was made this past weekend. So he's definitely implying there that the Fed stepped in, government stepped in, they backstopped deposits in Silicon Valley Bank, and they seem willing to do that for other banks if other regional banks started to get into trouble, which is kind of what's happening. I'll go through that in a minute to explain what's been happening very recently in the last few hours, in fact, and in Europe too. But he's saying that he thinks the market will bottom soon. I think he's saying this. He's saying it might bottom soon after this panic finishes, as it did in 1907. And it's worth going into 1907 just a little bit to see what happened there. If you're getting value out of this episode, please hit that like button on YouTube or on Rumble if you're watching there, to help to spread to more people and to give me that little dopamine hit that we all like when people like our stuff. Thanks. Okay, here's just a little bit of a background on that panic of 1907. You might be interested or not to know that I used ChatGPT to quickly give me the answer here, specific answer, rather than going through lots of links in Google or what have you. It's really good for that. I've made previous videos. My last video was about GPT-4, if you want to go and have a look at that. I asked it to explain what led to the panic of 1907 and how it played out. And what it said in part was, the Panic of 1907 was a financial crisis that began in the United States in October 1907 and lasted until late November, so quite short, as Burry is talking about, of the same year. The panic was caused by a combination of factors, including the collapse of the United Copper Company, the loss of confidence in the Knickerbocker Trust Company, and a liquidity crisis in the banking system. At the time, the United Copper Company was one of the largest copper mining companies in the United States, but its stock price had been manipulated by a group of investors. When the scheme was exposed, the company's stock price plummeted, causing a chain reaction in the stock market. The Knickerbocker Trust Company, which was heavily invested in United Copper, was unable to meet the demands of its depositors, leading to a run on the bank. So the Knickerbocker Trust was heavily invested in United Copper, and United Copper got into trouble, which led to a bank run. The panic quickly spread to other banks and financial institutions, and a shortage of cash and credit caused many businesses to fail. So we have the spreading effect, the contagion. As a result, the economy went into recession, with unemployment rates rising and many people losing their savings and investments. So that's what can happen in a bank run, and it can spread wider. So to address the crisis, several prominent bankers and financiers, including JP Morgan, organized a consortium of banks to provide emergency loans to troubled banks and companies. This helped to stabilize the financial system and prevent further damage to the economy. So this is pretty similar to what's happening now. This is actually after Burry tweeted the bankers and financiers are getting together still, the Federal Reserve, of course, to provide liquidity to the banks to make sure they don't get into trouble and it doesn't spread. Although we can see signs of a little bit of spread, and you can see how this could happen. But Burry thinks a stand was taken and the market could bottom soon because it was stopped. So this panic in 1907 is quite often cited in history of financial markets because of this. The Panic of 1907 was a turning point in the history of the United States, as it led to the creation of the Federal Reserve System in 1913. A few years later, the Federal Reserve was established to provide a stable and flexible monetary system to prevent future financial crises. The panic also led to increased regulation of the financial industry and greater oversight of stock market activities. Stock market was more of a Wild West back then than it is now, although we can see sometimes in booms and bubbles it still has that flavor to it. So it led to the creation of the Fed, and the things that JP Morgan did with the group of wealthy individuals back then. The Fed has that job now of trying to prevent financial crises when they start to occur. So the Fed's been raising rates lately, and the old saying about let's raise rates till something breaks, and this could be argued that something is definitely broken, and maybe Michael Burry sees this here. Something's broken now. The Fed will stop what it's doing and maybe stop quantitative tightening, and a little bit more on that in a moment, because there are signs of that. But is Burry correct if that indeed is what he's saying? If the contagion will be nipped in the bud, there'll be no spread? Because let me go through a few slides here of what's actually happening since he tweeted that. So the First Republic Bank dropped 62% the other day. It had a bit of a bounce since then, but people were definitely concerned. The market was concerned. It dropped nearly 86% since its all-time high, and you'll see on the screen there if you're watching on video the huge drop when the Silicon Valley Bank crisis happened and after that. And Western Alliance has been another one that's been in the spotlight. That dropped 47% in one day, and you can see the stock graph there, 78% below its all-time high. And there was some evidence on Twitter of a bank run starting like Silicon Valley Bank on First Republic. People put images on Twitter of people lining up outside the bank. You can see various different branches, including Brentwood in Los Angeles, which is, of course, a pretty wealthy area. So people would have more than the $250,000 insured level, possibly, probably. And there was also this headline, Charles Schwab moves to reassure investors it has plenty of liquidity and business is performing exceptionally well. It's a much bigger company, so there has been cited concerns in recent months over Charles Schwab as well. And here we see today, First Republic, after that huge drop today, it was up nearly 10%. And the reason for that, of course, was that First Republic to get a $30 billion rescue. This is a Bloomberg headline. I've got a little bit of a video clip to explain what's going on there.
The banking fallout continues as the American government tries to orchestrate a rescue of First Republic Bank with the aid of the nation's biggest banks joining in a public-private partnership that could result in about $30 billion of deposits, I'm told. Joining us now, Herman Chan of Bloomberg Intelligence. Herman, is this going to be enough?
I think so. I think what the government, in conjunction with the private sector banks are doing is drawing a line in the sand, saying that SVB happened, Signature happened. We're not going to let First Republic become a failed bank.
So the wording here is interesting because we're talking about capital infusions, we're talking about liquidity, we're not talking about an acquisition yet.
Correct.
Do we get there?
I don't think so. The reason why it's structured as deposits is to really shore up the confidence that for the remaining First Republic depositors, trying to tell the story that if the largest U.S. banks like J.P. Morgan and Citi and Morgan Stanley and Wells Fargo and PNC and Bank of America are looking to put their own money at stake in First Republic, then everybody else should be able to sleep soundly with their money at First Republic as well.
And how does that have a ripple effect across some of the other banks as well? Is this kind of, in some ways, safety or assurance for the likes of PacWest, for Western Alliance even, that if First Republic can navigate this, then we can too?
Exactly. This is shoring up the confidence for the entire regional banking space. Hopefully, the markets can breathe a sigh of relief and go on and understand that the government and the largest U.S. banks are going to shore up the stability of the regionals.
If you've got J.P. Morgan, Morgan Stanley, and others already helping out First Republic, is PacWest next? What are we looking at here?
I think the inference is that if J.P. Morgan and the largest other U.S. banks are going to help out First Republic, it's just a sign of confidence overall. I don't think they need to do anything else and to dip into Western Alliance or PacWest or any other bank that is viewed as potentially vulnerable. It's more of a fact that this is a decisive action by the government in conjunction with the largest banks, and that should shore up the confidence in the entire system.
Meanwhile, over in Europe, Credit Suisse, you might have seen news about this as well, about the recent problems it's been having. But if you look at the stock graph, and you've been following the news about Credit Suisse for years, it's been having problems since the global financial crisis. It's down 97.59% since April 2007. Been going down ever since. Every now and then there'll be news about it, and this is just the current situation. But there have been moves there to shore up the bank as well.
Central banks, the lender of last resort, that's one of their key roles. And there's, again, we look at inflation, we look at the economy, but financial stability, that's the other big responsibility of central banks. So the Swiss National Bank stepping up and putting up the 39 billion Swiss francs, the 50 billion worth in terms of dollars. They're going to use it immediately. It's a covered loan facility. It's going to strengthen their liquidity coverage ratio. All the things that investors want to hear from a central bank that has a bank that's in trouble.
This has just been happening hours ago. So there is a little bit of a cascading effect of spread. There is worries about contagion. So will Michael Burry be right that it's kind of nipped in the bud? We don't know yet, but it's interesting that these few things are happening. People are worried about there being a bank crisis and further bank runs or bank collapses. And then we have this from just hours ago. Lisa Abramovitz from Bloomberg says, did quantitative tightening just end? If you're on video, you'll see the big spike in that graph there. The Fed's balance sheet grew by about $300 billion in the past week as the US sought to backstop deposits at regional banks. So that's the making a stand that Burry was talking about. That's a big stand, and doesn't mean that quantitative tightening is finished, which often has meant in the past that when the Fed turns like that, then the markets also bottom soon after that. So it goes from tightening to loosening again, and financial markets like that. So is this the bottom of the market this time? Burry seems to think so. I think that's interpreting his tweets. That's what he's saying. But of course, other things could happen. He could change his mind. But that's where it stands right now. I think that's what's going on and what led up to just hours ago today. So what do you think? Let me know in the comments. Do you think Burry is right? Do you think that's actually what he's saying? Do you think the market will bottom soon because quantitative tightening is finished and there was a bank run that was stopped and things are turning around now? He's been very bearish since really 2020 or even before that. Is he getting less bearish now, and do you think there's a turnaround in the market? So if you've got this far in the episode, please consider subscribing on YouTube or Rumble or Spotify video or on audio in your favorite podcast app. And I'll see you next time. Thanks for watching or listening.